Hello, everyone. I see that it's 12 o'clock. See some people are joining, so we're going to wait a few seconds to start. Okay, I think we can start. The session is being recorded, so everybody else who's joining later can watch the introduction. Again, my name is Andrea Aguilar, and today is my pleasure to introduce to a new team member of the tax section. Jennifer Migliori is our new Assistant Director of the Education Committee. Jennifer and I will be working together in the Education Committee, but she will be your main point of contact to coordinate the future CLE sessions. So Jennifer, please.
Thank you, Andrea. My name is Jennifer Migliori. I'm the Assistant Director of the Education Committee of the Tax Section of the Florida Bar, as Andrea just explained. I practice in the area of international tax, and I'm a partner at Duane Morris in Miami. And it's my pleasure today to guide you during this tax section CLE called Dead But Not Done, Postmortem Tax Planning. I'd like to start today by sharing the CLE course number, which is 6591, and that will be shared again at the end of the CLE presentation. And before we get on with introductions, I wanted to share important information about upcoming CLEs and workshops with the tax section of the Florida Bar. On September 6th, we're having a free CLE for section members called Cross-Border Divorces in Post-Tax Reform World. And that will be a webinar which will be held by will be presented by Stuart Kastner and Carolina Nuche of Holland and Knight. I also want to remind you that we have the 2023 fall section meeting coming up that will be held September 28th through October 1st and take place at Rosen Shingle Creek in Orlando. I do believe registration is open for that, so please register for that. So I'd like to start by presenting our sponsor, Roy Myers, of MPI Valuation Professionals. He'll join us today to say a few words about MPI. Roy?
Thank you, Jennifer. Just want to keep this fairly short. We don't have a lot of time here, but we've been a long time sponsor of the tax section. We've been sponsoring the tax section probably for, it's going to be 25 plus years now. And we've been sponsoring the tax section longer than some of the members of the tax section have been around, I think. But we are a business valuation and advisory firm. We provide valuations for a wide variety of tax, financial reporting, and various business applications, as well as doing corporate advisory work to business owners and their representatives, and representatives being mostly legal counsel. We are national in scope. We were founded in 1939. We specialize in business valuation. We do some forensic accounting, but business valuation is really the thrust. We're involved in litigation support, various types of corporate advisory work. We do some fairness opinions, do some buy side and sell side advisory type of work. But at the end of the day, the gift in estate, the gift in tax type of work really is our bread and butter. And I think what we're best known for, and really as far as the tax section is concerned, the people that we know exactly that type of work. I've been with the firm my entire career. Kind of hard to believe it's the only thing I've ever done. I joined back in the 1980s. We are independent. We do not answer to anybody other than ourselves. We're not owned by somebody else. We're truly independent. And I think we do it for a very long. We're also involved with the reptile section of Florida, Heckerling, the Southern Fed Tax Institute, a lot of Southern-based things, despite the fact We are based in New Jersey, but we have a long time presence in the Southeast. So I think with time in mind, probably yield the floor and say thank you very much. And anybody that has any prospective type of work that we could do, any questions, comments, feel free to contact me. I'm on somewhere on the website, you'll find me. And you just use the letters that are up on the screen, they're MPI, www.mpival.com. You can find me. Thank you, and I appreciate the opportunity.
Thank you, Roy. So our plan now is to introduce the speakers, but we do have a question here regarding materials for the webinar. Whitney will be sharing that. If it didn't already pop up in your chat, I know that at one point the slides were dropped, but those can be shared again and will be shared during the presentation. It's my pleasure to introduce our speakers for today. They are partners who join us from the firm of Pannone, Lopes, Devereaux, and O'Gara, Jean Carlino and Leah Foertsch. Jean Carlino has more than 25 years of experience in all areas of estate and tax planning and administration, probate administration, trust litigation. His practice includes advising and advocating for clients in all matters involving federal and state taxation, including representing individuals before the Internal Revenue Service. In 2022, he was chosen as a fellow of the American College of Trust and Estate Council, ACTEC, the most prestigious organization in the U.S. for estate planning and trust counsel. Thank you, Jean. Leah Foertsch is also joining us. Leah is the office managing partner in the Boca Raton office for the firm, and her practice includes advising individuals and families in all areas of trust and estate planning, probate administration, and she has extensive experience with individuals and businesses in asset protection, wealth management, and tax strategies, and has managed multi-million-dollar real estate transactions. She has written extensively on topics in the area of trusts, including the trust beneficiary's right of access to information, published in the Florida Bar Journal. Thank you, Leah and Jean, for joining us today, and we look forward to the presentation.
Thank you.
Floor is yours.
Thank you.
Thanks. We kind of set this up. Jean's going to kick us off with disclaimers, then I'm going to come back in for powers of appointment.
Great. Thank you. Thank you, Leah. Roy, your sponsorship, we're indebted to. Jennifer, appreciate the handoff. I'm going to dive right in. I am speaking on post-mortem planning, focusing on disclaiming. I'll touch on building in disclaimer planning within the confines of your estate planning, even in a pre-mortem context. We're going to look at how we can use disclaiming beneficially from an estate tax standpoint, an income tax standpoint, evaluate the impact and effect and comparison of portability, and also take a look at some state transfer tax issues. The disclaimer statute itself is found in 2518, and as tax statutes go, I find it probably one of the more readable statutes. It has 4 primary requirements, and they're straightforward. The disclaimer must be irrevocable, must be unqualified in writing. That's the first requirement. The second is there's a time clock. We have a shot clock on this one. It's 9 months. The disclaimant has to execute the act of disclaiming within 9 months of the date that the disclaimant became vested in the property interest. We can get tripped up here. If our estate tax return is extended, we might get lulled into thinking that we have additional time, but we don't. It's a hard 9 months. So we need to be mindful of that. A lot of gray hair was lost during the pandemic when we wanted to disclaim and we needed a fiduciary, and getting in and out of court was difficult. But we have a 9-month shot clock. The party disclaiming must not receive any benefits in return for disclaiming. Can't be a quid pro quo. If I disclaim it's going to go to you, we're going to save tax, but you promise to give it back to me. That's always challenging because most of the disclaiming is done for economic reasons. And I think how you maintain your file and the dialogue that you put out there is important. And the fourth requirement is that the property that's disclaimed must pass to somebody other than the disclaimant. And the exception is that it can come back to a spouse. So against those four straightforward requirements, let's take a look at the different types of assets out there and how disclaiming actually works. So with jointly owned assets that are financial in nature, it's a lot like your Schedule E2 of your 706. It's a contribution rule. You have to look at the source of the money in the account. As we know, because those funds in most joint accounts can be withdrawn unilaterally, there sort of is no vesting. So upon death, when it's a joint account, what can be disclaimed is what was not contributed by the party who desires to disclaim. An exception to that is real estate. You might remember 100 years ago from your real property class, the concept of unities in property. So with a tenants by the entireties or joint tenancy with rights of survivorship, when that deed is executed, parties have vested rights. So at that point, a 50% interest is disclaimable. And so that rule is a bit different there. When we look at how to use disclaiming beneficially in the post-mortem context, in the estate tax arena, there are generally two scenarios we look at. And one is underutilizing the marital deduction, and the other is overutilizing the marital deduction. I know a lot of these issues we're contemplating less because of having no estate tax in Florida and because of super high exemptions and because of something like portability. But nonetheless, we still have to keep disclaiming in mind. Sunset is on the horizon from a federal level, and we'll get into this in a few seconds, but you have state estate tax considerations where exemptions are much lower. So if we've underutilized the marital deduction, the estate plan has left too much or an amount in excess from a tax standpoint of available exemptions. And of course, the party that is the benefactor of that can execute a disclaimer. And if the estate plan allows for the property to be directed back to a spouse, we can get into a situation where we optimally disclaim, get down to zero tax, so that only an amount equal to exemptions are passing to non-spouses and everything else to a spouse.
We're still looking at page 1 here of the slides.
Thanks. Thank you, Jen. I want to move that forward. Thank you. Appreciate that. The next would be overuse of the marital deduction. And here, for one reason or another, despite the best intention, assets in excess assets less than available exemptions, so exemptions are not optimally utilized, are left to a surviving spouse. So a surviving spouse receives so much that the spouse who dies first is failing to utilize their full exemptions. So here in this situation, a surviving spouse may consider executing a disclaimer to direct assets into a pot so that we can fully utilize the exemption of the spouse who passed first. It's interestingly enough, a surviving spouse, if they do disclaim and assets pass to what we used to call a credit shelter trust or a sub-trust designed to fully use either federal or state exemptions, that spouse can have an interest in that trust, and that spouse can also have a power over that trust as long as it's limited by an ascertainable standard. What we want to avoid is if it's a non-spouse disclaiming and that property is going to hit a trust over which that non-spouse has a power. That would be a disqualified disclaimer. It wouldn't cut the mustard, so to speak, under 2518. However, there's a distinction to be made if that individual is acting as a fiduciary and not in addition to being a beneficiary of the trust, they can have a power as a fiduciary, not in their individual capacity, a discretionary power to distribute income or principal, but that must be limited by an ascertainable standard. So on a federal level, we do have portability, and having portability from a conceptual standpoint, it's been around for a while now, about 12 years, before Jennifer reminds me. We do have portability, and it has taken away some of the harshness of failing to evaluate or potentially incorrectly evaluating whether or not to disclaim. We do get the benefit of our spouse's predeceased spouse's unused exemption. However, the issue doesn't end there. It's not simply a matter of that there's portability, so we can ignore the aspect of disclaiming. As we'll discuss in a minute or two, there are state estate tax considerations and even federal transfer tax considerations that really force us to make sure our file is documented, that we've evaluated the disclaimer option. Many of the clients that we meet in Florida, they still have either significant assets in other parts of the country. Even though they've become Floridians, they may have multiple pieces of real estate in New England or the Midwest, wherever they're from. And or they may be older, and we need to be mindful of the fact that it's not all that uncommon that although the golden years, are spent in beautiful Florida, that when individuals are really nearing end of life, that oftentimes they will return home to be with adult children and loved ones for convalescent reasons and support reasons. So we need to be mindful of the fact that there may be other state considerations in play. And that becomes a two-tiered analysis, quite frankly. Most state estate taxes range somewhere, about half the states still have estate taxes, and effective rates range between 10 and 15%. So when we are evaluating portability, not for a federal level, but on a state level, looking to not pay any state estate taxes because the right structure is there. It's just that assets are not titled in a way to get to zero tax on a state level. We need to do a second layer of analysis, and that's an income tax analysis. Generally speaking, capital gain rates are higher than estate tax rates. We can't stop there. We have to put pen to paper. In some cases, the math will bear out that exposing a family to state estate tax on the death of a second spouse is a cost that's worth incurring because of the fact they have highly appreciated assets, and getting that step up is going to save them more. In other cases, we're going to have clients and families that they're either cash heavy or qualified retirement plan heavy, namely assets that are income in respect of a decedent that don't receive a step up in basis, or that they have significant real estate that they're never going to sell They bought in a seaside community 30, 40 years ago, and what they paid 50,000 for has become 5 million. And those are real examples. I practice in 3 states. One of them is Rhode Island, and I have clients who have property that's near Taylor Swift's home that they have owned for 50 years, and they bought at a pittance, and it's now worth an ungodly amount. But they don't have the cash resources in that instance to pay the state a state tax. So they're foregoing a basis step up and doing transfer tax planning. But my bigger point is, don't get lulled to sleep on portability. And because we're in Florida, our Florida clients have assets in other parts of the country, and you need to evaluate disclaiming on level 1. And if you can save a state tax, then evaluate whether or not it's better to save a state tax or better to cause state a state tax and get a step up in basis. Slipping to the income tax side of the coin, we now live in a post-Secure Act world. We all remember having the bejesus scared out of us that we were going to be sued to kingdom come if we didn't get extended payouts for our wealthy clients who left their $1 million retirement plans to their great-grandchildren and had 90-year payouts, and we would have had loss deferral that was in excess of our malpractice policy limits. But Congress decided to let estate planners sleep at night, and they dropped the payout periods, generally speaking, to 10 years. However, we have this new class of beneficiaries, EDBs. It originally was designated beneficiaries. Now it's eligible designated beneficiaries. And eligible designated beneficiaries do get extended payouts. They, generally speaking, fall into 3 or 4 classes of people: spouses, disabled, minors, and in regard to disabled, there's the chronically ill as one class, and then there's a 4th class, those who are less than 10 years younger than the plan owner. But the real planning that I see revolves around spouses and disabled. If an estate plan is broken down or comes into fruition by virtue of assets going in a qualified plan going to children, and there is a younger spouse, a spouse can get life expectancy payouts. So we want to evaluate disclaiming there. And obviously, we need to be mindful of, these are typically family unity situations. They are not families where there is division, if you will, which, if it is family unity situations, we now have another concern, don't we? That are we bringing into play the quid pro quo concern? Something we touched on at the top of my discussion, namely, is one person disclaiming this because they're going to get something more on the other side. As a tax practitioner and doing this for 30 years, I do live in the gray, and I try to document my file carefully. I don't think just because you happen to get an offsetting benefit by doing something that necessarily means that your disclaimer was unconditional, but a poorly documented file and emails that think out loud too much can be detrimental in that regard. But in any event, with spouses and especially with disabled individuals with life expectancy payouts, you can do some, really exceptional things. Getting life expectancy for a disabled individual and having it pay into a special needs trust can be a powerful financial tool for that disabled individual. So actively in the planning phase, building a disclaimer concept into your planning is helpful, so that you can with ease execute the disclaimer at death. So you could have the primary beneficiary be the surviving spouse, the contingent beneficiary being the credit shelter trust, and the contingent beneficiary. To use Natalie's chote phrase, if you end up doing a custom drafted beneficiary designation clause, you would have the special needs share for that's established under the credit shelter trust for the special needs beneficiary. And then by virtue of a couple of disclaimers, you can get that qualified retirement plan down to the special needs trust share. And of course, you would have drafted that share properly, so it's looked through, so you can get life expectancy payouts. I'm running a little short on time, and there's a point above that I wanted to make that I glossed over, and if it comes to me, I will go back. I apologize. Considerations for disclaiming versus portability. We talked earlier on when we were just focusing on, do we have to not worry about disclaiming anymore because we have portability, and we have a client that's in Florida. He has or she has no assets in other states, and can we just ignore this analysis? So this is a chart. No pride of authorship. It did come from the BNA portfolio, which I have used my entire career as a valuable resource. First of all, is the estate plan you're looking at GST driven? We have to remember, even though we have portability, our generation skipping transfer tax exemption doesn't port over. So if we're looking at dynastic planning, but assets weren't titled properly to achieve that dynastic planning, then disclaiming is going to be portability. The next one, candidly, I take issue to some extent with the authors of the portfolio, but they note that joint tenants with right of survivorship or tenants by the entirety favors portability. And I assume that's because, when you exercise the decision to disclaim here, you're going to create a probate, and that in some states that haven't adopted the uniform probate code is going to expose assets to creditors. So the notion is that portability might be the way to go there. The next one gets us into income tax decisions. Are the assets likely to appreciate and not be sold? Disclaiming is the order of the day. We are not going to need a second step up in basis on the death of the surviving spouse. So let's disclaim, let's not pay any estate taxes, and let's use that exemption. Conversely, the next one, if the assets again are likely to appreciate, but they will be sold, then maybe exposing things to some estate taxes worth the step up in basis. Are we in a state, and this goes to, I think, the point that I wanted to touch upon earlier. Are we in a state that has a state-only Q-tip election? And when we talked about evaluating whether or not to make a state Q-tip election, to make a disclaimer at the state level, and you're going to evaluate paying estate taxes versus potentially saving capital gains tax. One thing to be mindful of is sometimes you have a boomerang effect. Assets are left to a spouse. The spouse disclaims them. They go to a trust, but that trust itself was a joint trust that doesn't use the exemption. So you may have to duck that boomerang and make two disclaimers. The spouse disclaims, it hits the trust. So all the assets are joint, no one did trust funding, goes to the surviving spouse. There is a joint trust. It does have credit shelter component in it, but you only get to it by disclaiming. That's a very common plan in the Northeast. So the spouse does one disclaimer, but then we need the trustee of the trust or of the marital trust or the spouse, depending on how the trust is drafted, to make a second disclaimer. But again, as noted in the chart, disclaiming is favored there. Is the surviving spouse likely to remarry? No one has a crystal ball, but if there is a remarriage, then there's nothing is going to port over. So that favors portability. Last, the Medicare tax. We know trust hit the highest rates much sooner than individuals. And if we're looking at significant passive assets, we need to factor in the higher thresholds for individuals than for trusts in regard to the Medicare tax in our decision. Let's see. There's, I think, some good material attached to my submissions, and hopefully they made it to you. I'm going to yield the floor to my erudite colleague, Leah, to talk to you about powers of appointment.
Thanks, Jean. I was going to make some joke about having less gray hair than you, but that doesn't seem nice. So some great information on disclaimers. Now we're going to jump into powers of appointment. So with respect to powers of appointment, we're going to start out by considering what comprises a power of appointment, the differences between general and limited powers, some cases in IRS guidance interpreting powers of appointment, and then some drafting notes. So initially, the sections governing powers of appointment are Internal Revenue Code 2041 and 2514, and then Florida Statutes, Chapter 709. So initially, a power of appointment is defined by the Uniform Powers of Appointment Act as a power that enables a power holder acting in a non-fiduciary capacity to designate a recipient of an ownership interest in or another power of appointment over the appointed property. And working through this definition, we have several parties involved. First, the donor is the creator of the power of appointment. The donee or power holder possesses the ability to exercise the power, and the appointee is the party who receives the property, which is the subject to the power of appointment. Finally, if the power of appointment is unexercised, the takers in default are the parties who will receive the property. So a threshold determination must be made as to whether the power of appointment is general or limited in nature, as that is the determining question in considering estate inclusion. Helpfully, and we're all tax people, right? So you've seen this before. Under the code, a limited or special power of appointment is, quote, one that is not general. Great definition, just very helpful. But we do have some guidance in that a general power of appointment allows the exercise in favor of any or all combinations of the donee, the donee's estate, the donee's creditors, or the creditors of the donee's estate. So I'd like to briefly consider just a couple of examples here. First, at the death of my wife, my trustee shall distribute my residuary trust estate as my wife appoints in her will, other than to her estate, her creditors, or the creditors of her estate. My wife may appoint my estate outright or in further trust under such terms as she may determine. Okay, so this would be a limited power, right? Because we've excluded the estate, creditors of the estate. A second example, at the death of the beneficiary, my trustee shall distribute my estate in such shares as the beneficiary shall appoint amongst the issue of my brother. This one gets a little bit goofy because let's pretend for a second that the brother is the beneficiary. This would allow him to appoint, to his estate essentially. But it is written, if the beneficiary is not in fact the brother, this would also be limited. Finally, I hold a power of appointment over the property located at 1 Blackstone Way. I appoint the property to my son for his life and then to such of his issue as he may appoint by will. So again, it's limited to his issue. So the holding, whether or not exercised, of a general power of appointment causes estate inclusion is a general power of appointment over property is an exercise of privilege of directing the property. A limited power of appointment is taxable to the holder, where the holder exercises the power to create another power of appointment, which has the effect of postponing the vesting of the interest in property for a period which is ascertainable without regard to the date of creation of the first power. The inter vivos exercise or release of a general power is a transfer which may be subject to gift tax. So in drafting these, one should also be aware that where a beneficiary possesses a general power of appointment, grantor trust status can result, such that some or all income is attributable to the beneficiary. So just kind of be aware of that in drafting, that you could trigger grantor trust status. In the Phipps case, which is a 1940 Florida Supreme Court case, the court kind of defined general versus limited powers in stating, quote, the powers vested in a trustee under a deed of trust may be general as when exercised in favor of anyone the trustee may in his discretion select, or special as when exercised in favor of the persons or class of persons named in the trust deed. That's end quote. If the trustee is granted a general power of appointment, he can either appoint himself or any other person. However, when the power of appointment is special or limited, the trustee must appoint a person in compliance with the terms of the trust, such as a member from a class of persons provided. So we're going to see later when we talk about drafting that we need to get very specific in terms of how we exercise these powers and make sure that the exercise is in strict compliance with the instrument that creates the power. So keep in mind here also that the trustee is a fiduciary, so may not be the best power holder. Excuse me. The timing of the creation of the power of appointment can be important as well. If a power of appointment is testamentary, it is created at the testator's death. If the power is contained in a trust, it is created on the date the trust is executed and funded, regardless if the power is exercisable at that time, whether the trust is revocable, and whether the identity of the holder is not ascertainable until after the date the instrument takes effect. Further, if in exercising the power, the donee creates a second power, the second power is deemed created at the time the first is executed. So you can get very into kind of the nuances of the timing with these things. Power of appointment is not general, where it is only exercisable in conjunction with the donor, if exercisable only by the donee in conjunction with an adverse party. So we have our adverse party rules as well, who has a substantial interest in the property, or if limited by an ascertainable standard. So we also talk about the ascertainable standards and disclaimers. We're going to consider them again here. With respect to the third exception, that ascertainable standard exception, in drafting, one should specifically use kind of our buzzwords, right? Health, education, maintenance, and support is the standard. So just keep in hems. Don't get crafty with what else you could use. Otherwise, you run the risk of inadvertently creating a general power. So words such as things like happiness, welfare, comfort, or well-being could result in classification as a general power. So I think it's my practice. I think I can probably speak for Jean too. When we draft these things, just use hems. It makes life easy. If state law, on the other hand, provides that any such descriptors constitute an ascertainable standard, state law will apply so that the power is not deemed to be general. So if I haven't seen such a state law, but I'm only licensed in Florida. So maybe folks who are licensed in other jurisdictions have a list other than HEMS that they can rely on for this. For my purposes, health, education, maintenance, support. A power of appointment can be created by explicit grant in the will, trust, or other writing. A couple of examples here. First, where the language in a will gives the estate for enduring her natural life, and concomitantly broad powers are given to encumber or sell, and the recipient is authorized to use the estate as necessary for support, maintenance, comfort, or welfare, a general power of appointment has been granted such that the value is included in the beneficiary's estate. Where a beneficiary was given the use, benefit, and enjoyment of property with full power to dispose without court permission, with full rights to income and principal, the value was included in the beneficiary's gross estate as he possessed a general power of appointment. Finally, where a surviving spouse was a beneficiary of the income for life from two trusts, and language in the first trust allowed the spouse to invade the corpus without restriction, the surviving spouse had a general power of appointment over the first trust, so the value of the first trust was properly included in her gross estate. But as to the second trust, the surviving spouse had only a life estate and no power of appointment over the corpus, even though the second trust incorporated the administrative provisions of the first trust. A general power can also be created by implication, leaving property or contributing property to a trust created by another person, which person also has the power to revoke or change the terms of the trust. The settlor is the donee. Drafters, then, we should carefully draft the power of appointment to be unambiguous and to provide specific instruction as to the manner of its exercised, to what extent interest can be created, and whether a successive power can be created by the donee. Additionally, as a general rule, the donee's exercise of the power must comply completely with the formal requirements imposed by the donor. So again, just be in strict compliance with whatever your governing instrument says in terms of how that power is then exercised. Under the restatement in the Uniform Act, the donee must manifest the intention to exercise the power of appointment, be in substantial compliance with the restrictions imposed by the instrument which grants the power, be a valid exercise of the power under applicable law, and appoint amongst only permissible appointees. Where the donee is given the power to appoint in trust, doing so gives the donee some power over the establishment of the trust terms. So this is sort of a nice way to incorporate post-mortem flexibility, right? If we are appointing amongst a class of minors, for instance, we have no idea how they're going to behave with money or what their kind of personal preferences may be or what substance abuse issues they may have. So drafting a power of appointment that allows the property to be appointed in further trust and giving some scope as to the terms that you could incorporate in that further trust created by the power of appointment definitely gives you some additional flexibility. And I guess you could say it's kind of ruling from the grave, right? Or controlling from the grave, but that's not necessarily a terrible thing. So you want to consider then, whether the new trust terms can be included. And generally the trustor under this new trust must have a property interest equal to or greater than that which he endeavors to convey in trust. So again, strict compliance with the terms of the power of appointment as laid out in the governing instrument. So where the terms of the subsequent interest exceed the ability of the trustor or to establish, the new trust would probably be valid only to the extent allowable under the governing instrument. It would generally be construed to contain the greatest grant possible, but just kind of be mindful. Let's see, I'm getting a little nervous on time here. I think I'm in good shape, but let's see, let's skip on to the kind of basis considerations. The basis in property where a power is exercised, not created, is the fair market value at the date of the death of the alternate or the alternate valuation date. If the power is not exercised and the property passes at death, then again, the fair market value or alternate valuation date governs. I'd like to briefly consider a recent PLR 2022-06008, where the IRS considered and offered an opinion where the trustee sought to create a power of appointment in the income beneficiary of the trust. At the grantor's death, a trust was established for the benefit of the sole surviving child. The child was entitled to the income, and the trustee could withdraw for the child's HEMS within the trustee's sole discretion. At the child's death, the trust was to terminate and directed distributions to the child's surviving descendants per stirpes, and if none, to the wife of grantor's heirs at law. A controversy arose, which centered around the trustee's desire to exercise his discretion to give the child a power of appointment over certain trust assets. The justification offered for granting the power of appointment was to keep the assets in the grantor's family and to minimize transfer tax. A settlement agreement was reached, giving the child a testamentary power of appointment to appoint a defined portion of the trust estate. The defined portion meant, in this context, the largest portion of the trust that could be included in the child's federal estate without increasing the total amount of transfer taxes. So, failure to exercise the power would result in distribution to the child's living descendants per stirpes. The service concluded that only the property subject to the child's power of appointment would be included in the child's gross estate. I found this kind of proffered justification to be a little weak. Securing the interest to keep it in the family, it seems a little illusory to me. Prior to the creation, the child's descendants would have inherited the assets anyway. So the child now just has the power to pick and choose between his descendants. Further minimization of income taxes resulted from the inclusion, but not of transfer taxes. The kind of cool takeaway, even though this is PLR, is the use of a formula to trigger inclusion in the power holder's estate and provide the step up in basis without blowing the child's exemption. So if you're into this, I would take a further look at that PLR. I've got a couple of cases I'm going to skip by here. So just see. I'm going to pull it like Jean did and come back to these if we have time. So again, when we consider kind of the exercise of the power of appointment, generally speaking, the donee is able to transfer the property in further trust, barring a prohibition in the governing document. And additionally, the donee can represent and bind persons whose interest as permissible appointees, takers in default, or otherwise are subject to that power. But the donee does not have carte blanche in establishing the terms of the further trust, as the donee must have a property interest which is equal to or greater than what he subsequently conveys. So by extension, the donor of the limited power of appointment is a settlor of any trust subsequently created by the donee in exercise of the power of appointment. So just kind of keep in mind, who's creating what instruments and under what powers. With respect to revocation of powers of appointment, a power of appointment can be revoked if the power to do so is reserved and the revocation complies with the governing document. The power can also be disclaimed in whole or in part, and if properly disclaimed, it is that the power was never acquired. The donee can also relinquish the power held, but a relinquishment must be in writing. So there's kind of a cool case, which is the Amin v. Sjorgen, SJOGREN, 313 Southern 3rd 157, which is a Florida First DCA case from 2021. We'll come back to that one if we have time. So a further consideration with respect to kind of the creation and exercise of powers of appointment is the tension in the governing law. Generally speaking, the majority view is that the donor's domicile governs the exercise of the power. The restatement, on the other hand, provides that the donor's domicile governs the creation, while the donee's actions are governed by his domicile at the time of exercise. So in drafting, when would you want to include a power of appointment? Specifically and most frequently, a power of appointment can be employed to provide a mechanism for flexibility in handling the unknown. Because if your permissible appointees or your permissible appointees are sort of unknown as to how they're going to behave or how they're going to handle money, this is a nice way to kind of reserve the ability to continue to adapt to that. Consider situations, again, where you're drafting for like minor grandchildren, right? One has no way of knowing whether they will have substance abuse issues, credit issues, greater health or educational needs than other people in their class, or even kind of greater access to assets, right? Maybe they've married well. Or one of their parents, on the other side is a wealthier individual. You could utilize a trust protector here. The exercise of the power is done in a non-fiduciary capacity, so that would be an okay use of your trust protector. A trustee's similar actions could subject him to liability because, again, your trustee is acting in a fiduciary capacity. I think there'd be some tension there in trying to allow that. And your trust protector could also be given the ability to add or remove a general power, which would grant a huge amount of additional flexibility, especially as Gene alluded to in his earlier presentation with our changing tax landscape.
Yeah, Leah, if I may, I wanted to get
Please.
your thoughts on that. It's to me, it's exciting to have that potential to keep assets at first blush out of a beneficiary's estate, give them creditor protection, give them estate tax reduction, but also preserve the potential for a step up if that's what rules the day, right?
Yeah.
We live
Absolutely.
with constant tension between transfer tax and income tax. And along the lines of what you described, are you comfortable with a trust protector having a limited power to have a power to grant to a trust beneficiary the power to appoint solely to the creditors of their estate? So effectively dissuading them from ever exercising it, but yet achieving step up for the family, so to speak.
Now you're going to fire me up because I like that question, because I've been in preparing for this presentation, I was kind of thinking, what would stop? Let's say I've got, a second or third spouse who's significantly younger, right? And I give that second or third spouse the ability to appoint only to their creditors. What stops them from going through some mechanisms to appoint their new boyfriend, girlfriend, or to recast that person as a creditor, right? Yeah. I mean, how hard would it be to, borrow
Sure.
a couple $100,000 or a couple $1 million or something and document it with a promissory note?
Yeah.
And so that sort of, that concerns me just a little bit in terms of, do I actually give them an additional incentive to exercise that power to take it away from, my guy's family? Is that something that would keep you up at night, or am I going way off the reservation on this?
No, I understood. So what you're saying is, despite the draftsman's best intent to dissuade the would-be donee, that sure, we can have contrived situations that create creditor status. I'm comfortable with that it would work, that from a tax standpoint. And I like the notion of vesting it with a trust protector who can evaluate, right? He could be duped.
Sure. Yeah.
And all of a sudden the companion is going to show up on the landscape as a creditor. But I think it's just really cool to preserve all of those options.
Yeah. Oh, I think it's amazing. I just feel like in 20 years that there would be a moment where my eyes flash open at 4 a.m. and I get intensely concerned about whether, somebody constituted a real creditor or can we play games with this? Like we all do, right? Those 4 a.m. like, man, have I been screwing up for the last 20 years of my life in the way I've drafted these things?
Well, that's why we're all going to retire in an asset protection jurisdiction and put all our assets in
Who's
it.
retiring, Gene? Dead but not done after all. So I think that's a really interesting approach, and I like it because I do really like powers of appointment in terms of preservation of some flexibility in both tax planning as well as beneficiary planning. And I think one of the places I would caution is that sloppy drafting can result in these really unintended and undesirable consequences. I've seen 3 trusts in the last year and a half that were done fairly close to deathbed, and in a second, third marriage situation, not with common children. And for some reason, a power of appointment was given to the new spouse to appoint in favor of the grantor's, issue. And that just seems like a nice place for some manipulation. I mean, in a perfect world, right? The new spouse always gets along with the kids. But that just those kinds of things make me nervous, and I would want to sort of extensively document my file were I to give a similar type of power.
Yeah.
So I think in those situations, you really need to have kind of an extensive discussion regarding the family dynamics, and maybe not a bad consideration to speak to the kids a little bit if your client allows that. So as Jean said, you should also kind of consider your tax strategies here, inclusion for the basis step up and generation skipping transfer tax. And employing that lesson from that private letter ruling, formula drafting could be a really great kind of utilization. I'm not as brave as Jean. I didn't dive in much to the Secure Act provisions. I keep trying to, but man alive, I just keep hoping they go away. But I think you should consider the intersection of Secure Act along with your drafting of your powers. So I think there's just a lot of cool things that you can do with these things, and I hope we've illustrated some. Jennifer, I see you popping back in. Are we at time? We probably have more we could go through, but
we're coming up at the end of the presentation. We do have, of course, time to continue if there's more that you want to share. So don't let me interrupt, but I may just within the next 3 to 5 minutes open it up for questions if anybody has anything pressing.
Okay, well, my very brief conclusion to my powers of appointment, and then Jean, I'll let you if you have other things, but be specific in drafting as to the manner of the exercise, what interest can be created, can the power be delegated, can a second power be created, who's your donee, will your donee be up to the task, is the appointment discretionary amongst the class of permissible appointees, or do you want to provide some limitations, and then provide a good mechanism for the release of the power. So.
Sounds good. Jennifer, any Q&A that we might respond to in the remaining time?
Well, I don't see any questions on my end just yet, but I did want to say that these are excellent post-mortem planning tips on disclaimers, portability, application of Secure Act, and Leah on power of appointments and release of a power. Those are very important considerations. And what constitutes a creditor? I mean, that's
it could be I'm
rabbit hole.
Trouble. I've definitely been known to borrow trouble, but they are the things that wake you up down the road.
Yeah. So. No, I mean, that's something. And then it's proceed with caution. I mean, some people don't even think about that, so it's an important consideration for sure.
Yeah. And it's a good thing that Jean was involved in this one. My sort of working title was something along the lines of get ready before you're deady, or even after, but I'm really bad at naming things. So, post-mortem. So I think we're good, right, Jean? Is that anything else you want to throw in?
No, I enjoyed the opportunity to present. If questions come in after, certainly I'm sure this section will alert us, and I'll be glad to weigh in. And again, can't thank the sponsors enough, because
Yeah,
It takes money to keep this stuff going. And it's great that quality people like MPI are behind us.
yeah. Thanks for
Great.
the opportunity.
Thank you, Roy. Absolutely. Andrea, unless there's anything further, we do want to, of course, provide time for Q&A, but I haven't seen anything come through on my end.
No, that's it. Thank you so much for everybody's participation. And if you want to share the CLE course code one more time for people that join later.
Absolutely. The CLE course is 6591, 6591.
So Jennifer, the question, of course, is, are there no questions because we were unequivocally and
You
unbelievably
were
clear?
comprehensive
Or did we
and very
completely-
detailed and covered all topics.
Did we lose all the audience before we got?
And the slides were shared in the chat. I did see Whitney circulate those.
Okay. That's great.
And before
if
we
that's it-
conclude, Jennifer, if you want to share your email address for
Oh,
future
that's a great
communication.
idea. Yeah. So if anybody is interested in presenting a tax section CLE, we are always open to that and interesting topics that we haven't already or recently covered. I've just shared my address. Oh, I'm not sure that went to everyone. I will try this again. Oh, for some reason, I'm not given the option to share with everybody. That's odd. Andrea, that went over to you. If you could just drop that into the chat, that would be helpful.
No, I cannot, but it's fine.
Right.
We're going to share your contact
Okay.
information.
Thank
I
you
put
so
your
much.
I put your email down there. They should
Thank
have it.
you. Yes, it looks like maybe you have the ability to share with everybody. I don't want to keep everybody, so we're at the end of our CLE here, and if you don't have questions, feel free to drop off. I want to thank our speakers once again, Jean and Leah. That was an excellent presentation. So thank you for your time today.
Thank you.
Thank you for having us.
Thank you.